Okay, so okay, so what had happened was on Saturday morning, the U.S. carried out a mission to detain the Venezuelan president Nicholas Maduro and his wife on narco-terrorism charges. Let's talk about what this may mean for the global economic outlook. A lot of people are talking about this story as an oil story, but I want to look at it from a dollar perspective. Over the last 2 years, we've seen gold double against the dollar, moving from $2,000 to well over $4,000 per ounce. Some suggest this move was due to inflation, but if it was just inflation, the dollar would have began moving like this back in 2020. Foreign countries are selling dollars and buying gold because tariffs are lessening the desire for international trade. And if we aren't trading internationally, then there's less of a reason for foreign countries to hold US dollars. This idea is reinforced even if we look at the value of the dollar. Throughout the first few years post-COVID, even as we experienced an aggressive rise in inflation, the dollar traded in a tight 5% range. The dollar looked like it was preparing to strengthen against the rest of the world's currencies after the 2024 election. But once the tariffs were announced in early 2025, the dollar faced a lot of selling pressure, causing it to lose over 10% of its value. So, what does a weakening and less favorable US dollar have to do with Venezuela and Nicolas Maduro? Well, I'm glad you asked. Venezuela holds the single largest oil deposits in the world of any country. According to OPEC and the EIC, they have the potential to produce over 303 billion barrels of oil from their underground untapped stores. To put that in further context, Saudi Arabia has the potential to produce 267 billion barrels as a close second. And in total, humanity has utilized approximately 1.5 trillion barrels ever. Ever. But half of that has been since the year 2000. So if we zoom in a little closer, the untapped oil reserves in Venezuela could have supplied the world with all the oil it needed for the last 15 years. So what has it been doing with all that oil? Short answer, nothing. In previous decades, Chevron and other companies partnered with Venezuela to extract their oil out of the ground. But in 2007, Venezuelan President Hugo Chavez at the time ordered all foreign companies to leave and placed the oil fields under government control. After his death, the facilities were not kept up well, and critical repairs and upgrades were never made. The infrastructure in place has the potential to pull out over 3.5 million barrels of oil per day, as it did in the 90s, but so far it's been producing less than a million. With that, 60% of the oil it has been producing has been going to China, and at a cost well below market value, sometimes undercutting Brent crude prices by $15 to $30 a barrel. And at today's price of $60 a barrel, that's a 25 to 50% discount on oil for China. But even with the deep discount, less than 10% of China's international oil purchases come from Venezuela. So political and military strategists are suggesting this move may not have immediate political or military consequences just yet. With the US firmly in charge of the production, price, and movement of oil in North and South America now, we should not expect the price of oil to increase. Conversely, more oil on the market should suppress the barrel value, keeping it below $65. Back online and more oil is extracted from the ground, we should see an uptick in revenue from major oil refiners such as Valero. And since American companies will be back at the helm of drilling and refining the oil, that'll inspire countries to purchase oil in US dollars, which was the whole point in the first place.